All right, just like in the past, we've dealt with adjustments. There is a specific adjustment that's geared directly towards inventory, and we have to keep up with that as well. And that is specifically dealing with inventory that we lost or we were stolen. And so let's look at that real quick. Inventory shrinkage. What that is any loss of merchandise inventory that it comes from theft or deterioration. When you have inventory, things happen. Things break, things become deteriorated, things are stolen, and when we put this on our financial statements and we say this is what our balance of inventory is, we want it to be as accurate as possible. Not what we think we have or what we should have on our books, but we actually have on our shelves. So we have to make sure what we have on our shelves is the same than what we have on our books. And the only way to do that is to be able to take a physical count and make sure that our T-table is correct. So this is determined by comparing a physical count of inventory with the amount recorded on the records. So this starts by taking a physical count and then comparing that to what it says in my T-tables. And what happens here is if they're the same, I do nothing. The odds are that I have more on my shelves than I do in my book is slim to none. That means that somebody took something back and I didn't know it, or didn't buy something but bought something. But more times than none, I'm going to have the times where when I take the physical count, it's going to be less than what's on my books. And so what I need to do is I need to bring what's on my books down to what's actually on my shelves. And so the way to do that in journal entry form is I'm going to expense it using COGS, cost of goods sold, but I'm going to put these little parentheses to show, hey, this is not something that I sold. This is just the inventory that I lost, but I'm still expensing it because that's kind of the price of doing it, using inventory, because I know I'm going to lose some stuff. So I'm going to expense it through COGS, and then I'm also going to bring down my inventory account, so that's what's going to be credited of inventory for however much that amount is. And that's what inventory shrinkage, that's how we do the adjustments for inventory specifically. Appreciate it.